if you're managing to figure out the differences between cash flow and profit and the reasons for them, that's absolutely fantastic. Many congratulations. A lot of people find that very tough. The next tough thing is to work with the majority of people, dare I say, who don't understand this. So you're beginning to understand it. Your understanding is improving. We'll improve it further as this week continues and into next week. When you've sussed all that out and it begins to feel a bit more natural, you need to communicate with and work with the majority of people who have never invested the time to figure this out, or they have and they've forgotten, or let's say they haven't had the benefit of the kind of course where it was more achievable for them to do. So be nice to other people who aren't yet where you are as you think about especially accrued expenses, accrued expenses with an R. Accrued expenses. These are short term. This is what we looked at last time. When we move to provisions, as before, many things are the same. So let's visit what they are in a bit more detail shortly. Just for now, provisions are a form of liability. So they're another liability in our balance sheet. Payables, accrued expenses, and provisions. So another liability. And for this simplified balance sheet, we're just going to lump them together, aggregate them with trade payables, short-term accrued expenses. So here in our reconciliation, increase in payables, accrued expenses, and provisions. By the way, can you see the benefit of financial modeling? This is a financial model that is helping you, I trust, understand this concept. If we model the concept, then it's easy to duplicate things in particular. And a really good way to build understanding is get something working that you agree is right and that you know why it's right, and then duplicate it and modify it. So we're just making a few modifications to what we had before. So accounting for provisions, and what changes did we make? We changed that and that and that to make this slightly more general purpose, because everything that applied in cash flow versus profit or loss terms that applied to payables and accrued expenses, short-term accrued expenses, also applies to provisions. So many things are the same. What's different? Essentially, it's the nature of the liability. Provisions are longer term compared with accrued expenses. So accrued expenses generally relate to things that will be happening in the next period. Provisions might relate to a number of future periods. So they're relatively longer term in their nature, and the other difference is the amount might be subject to greater variability and indeed the existence. So a classic example of a provision is there's a legal case against us. We will defend this case vigorously. However, if somebody's suing us and we're vigorously defending the case, it doesn't mean it's necessarily prudent, realistic to say the amount of value that we need to set aside to cover that potential expense. It's really not realistic normally to put that at zero. So we need to be putting something aside in accounting terms to recognize, skilled and vigorous as our defense will be, nonetheless, we might not win. And in which case we'd might have to pay something, and we ought to tell our owners, our stakeholders about that by describing it, but also putting a liability into our balance sheet. So let us assume a provision. So recognizing a provision, let's say it's for this legal case. Recognizing a provision. We've done some excellent work. We're a superb repair firm. We've done some excellent work for a prestigious client. In our opinion, the client is most unreasonably complaining. So the client seems to not like the work and telling us they're going to court, or they might go to court. We ought to, unless it's completely frivolous, be saying something about that to our stakeholders, and often we'll actually be recognizing a liability. And let's say it's a bit more likely than that we'd have to pay. So let's say it's okay. There were some shortcomings in the work, and on balance, we're going to set aside 6. And let's say we'll account for this as a cost rather than negative income. So we recognize an expense in this period for 6 for our provision, and we'll need to reconcile the loss and the cash outflow, which didn't happen yet.